all-important earnings season has gotten over. To some people, it is, of course, on the headline numbers below estimates, but some analysis seems to suggest that while some heavyweights and some large companies disappointed and dragged the overall numbers down, in a lot of cases, the numbers were slightly above what the street was working with. But the question to our current set of guests is, what did the Citi team make of the quarter one numbers based on their estimates and otherwise? And what does the commentary leave them thoughts with for the quarters to come? It's my pleasure to welcome in Rashi Chopra, Aditya Jain, Saurabh Handa, and Surendra Goyal on the show today. All of you, thank you so much. Much appreciate you taking the time out. Surendra, can I start off with you? What did you make of the headline numbers? Did it disappoint you, or did you think that the broader markets fared a bit better than what you guys may have worked with?
Sure, Neeraj. Thanks for having us on the show. So, see, from a quarter perspective, I think firstly, the earnings trend was fairly mixed, I would say. At a headline level, if you take the top 100 or BSE 100 companies, the numbers have been broadly in line with expectations at EBITDA level. So it was a combination of better revenue growth, but then again, there was a significant margin compression. Again, not very different from what our team had anticipated going into the earnings season. So I would say it's broadly in line with earnings. Now, if you kind of go into some of the details, it does feel like that some of the more volatile sectors did drive earnings, and Saurabh is here. He can talk about energy later. But that, I think analysts were expecting high losses in OMCs, and those numbers came in slightly better and so on. So all of that helped reported earnings. I think the more important thing was that we have seen earnings downgrades over the reporting season for 2/3 of this 100 stocks. Okay, so while the earnings downgrades are not very big, at an aggregate level, the downward revision in Nifty earnings is 3-4%, depending on whose numbers you see, ours or consensus. But 2/3 of these stocks have seen downgrades. So I would argue that broadly in line, maybe qualitatively a little short. But again, this kind of misses and beats are very usual with quarters. They are not really that significant to call out.
Which prompts you, Surendra, I presume, to bring about the slight change in the index valuations or index numbers that you put out very recently, yesterday or today, I presume, for FY23. My question would be that, is there a chance for some of these revisions, always possible, but I'm still asking the probability of the revision upward happening at some point of time with the commodity price cool off that we've seen in some fashion, and the vagaries of the windfall tax at hand currently?
Neeraj, so it's very difficult to rule anything out. It's a fairly volatile situation because there are too many moving parts. On one side, higher interest rates, how they impact demand, etc., all of that remains to be seen. But at the same time, you have commodity costs cooling off. And while we are working with certain forecasts, if the cool off is more than what we are anticipating, definitely there could be a case for margin surprise. Particularly in a lot of industries, corporates have taken price hikes, and those price hikes may take time to be rolled off, right? It may only happen gradually, thereby providing some kind of a margin boost in the interim. So it is possible. Having said that, what I would want to highlight is at least we are baking in some conservatism in our numbers, I would say. If you look at Citi Research's FY23 Nifty earnings forecast, we are around 10% below consensus now. So we are baking in some amount of conservatism. But at a market level, I think it's difficult to see upgrades, right? The consensus is still building in fairly decent EPS growth numbers. So I really see that getting upgraded looks a bit difficult.
Got it. So maybe bottom up or maybe sector specific thematic horses for courses, and we'll talk about that. Surendra, we'll come back to you for IT. We'll come back to you for consumption as well, and maybe autos if you have some views there. But since you mentioned Saurabh, let me get him in first on the conversation. And then weave it to one space which had a great outcome, which is banking with Aditya, and one space which had a forgettable quarter, which is metals with Rashi. But Saurabh, to you first. What did you make of the earnings that came out, and how difficult would it be to pencil in what could happen in quarter 2, quarter 3, because commentaries may not have as much meaning as government actions would have in a large part of your coverage universe, I reckon.
Yeah, hi. Thanks, Neeraj. So, if you split the sector into, at least on the oil and gas side, into say 2 or 3 different subsectors, on the OMCs, as Surendra mentioned, there were significant losses. However, we had actually penciled these in, so we did know how bad marketing was because petrol and diesel prices had not been revised. So, I would say the loss numbers were actually not as bad as we feared, at least in a couple of cases. In HPCL, yes, the loss number was higher than expected, primarily because that's the company which is more exposed to fuel marketing, which is where we've seen all the pressure. If you switch over to the gas side, things were actually much better. So, for instance, the city gas companies all reported decent margin numbers. Most of them reported margin beats. In fact, in a couple of them, even the volumes were ahead of estimates, primarily because CNG conversions are still remaining fairly strong. Um, Gale also on the gas side reported strong numbers. Again, they are beneficiaries of what's going on globally on on the LNG side and the gas crisis. Um, and lastly, if you look at Reliance broadly inline numbers, the O2C segment was broadly in line, maybe a shade below estimates. It was offset by good performance in geo and oil and gas. So I would say that more or less the numbers were in line. OMCs maybe slightly, the loss was not as bad as feared. The city gas company is fairly decent. But on the OMCs, coming to the second part of your question, yes, there's significant uncertainty on near-term earnings. It's if you look at the variables right now, it obviously depends on what's happening in oil prices, not just oil prices, but also the product cracks on petrol and diesel, because this is what ultimately drives the under recoveries for these companies. Now, what we've seen in the last month or so is oil prices have cooled off. Product cracks have also cooled off. So actually, lower refining margins, ironically, are positive for the OMCs. Within them, something like an HPCL at the margin would benefit more. But we are still potentially looking at still losses on the marketing side. So say from a 20 rupee loss per liter, it has maybe narrowed to 10 rupee loss per liter on diesel, but it's still there. It's still material. So what will probably be something that the market will look forward to is either signs of more cooling off externally, say oil prices come off further or the cracks come off further, or some sort of direct or indirect relief from the government, either some kind of compensation as the government used to do in the past, or duty cuts, or maybe even resumption of price hikes, which is a little controversial though given the high inflationary environment. On the gas side, we are relatively more positive. There have been some positive developments on the policy side, which has driven a favorable view for the city gas names. Yeah, so that's broadly how I would sum it up.
Okay, just a word on CGDs, because I think the results print notwithstanding alone, the action taken on August 10th, I presume, or August 9th, as the case may be, and your notes seem to suggest that the outlook then at least was favorable before a bit of a run-up that we've seen already. What's your sense on what does this do to the predictability of earnings print for the next 3 quarters, if at all, and the outlook on the prospects of these names?
Yeah, so it is a fairly significant development in our view. So the government has essentially increased the domestic gas allocation for the city gas companies. Now, if you take a step back, the main pressure that these companies have been facing over the last year or so is rising gas costs. So essentially, the gas prices, which we are seeing globally, especially in Europe, is gradually, with a bit of a lag, also impacting these companies because domestic gas prices have been moving higher, which is a cost for these companies. On top of that, the domestic allocation, which this is the gas which is slightly lower priced compared to, say, LNG, that allocation also had come down over the last couple of years. Now, the government has revised that policy. They appear to be focused on maintaining a priority for the city gas sector. So they have increased the allocation of this sort of cheaper domestic gas, which is significant from a margin perspective. This was also something which a couple of months back, I think no one was really talking about. People had kind of assumed that, the sector might be a little dead. So to that extent, it's a bit of a positive surprise as well. Now we do have one more event coming up over the next couple of months. So this domestic gas price actually gets revised every 6 months, and on 1st October is the next revision. So net, what could potentially happen is the saving that they are seeing right now for this from this higher domestic gas allocation potentially can be offset by this higher gas price, which we see in October. So there is a little bit of still uncertainty. I think it really depends on, again, government action. I think that's something which we will be quite keenly watching. If there is any relief on the pricing front, that can be another big driver. But net, I think this has been a very significant policy development. It was, not entirely expected, because just 4 months back, the government had actually adversely changed the policy. So in a way, there's a bit of course correction. It appears that the government has identified, the sector as a priority area, and which is why CNG looks like something which is here to stay. So we are pretty positive on the stocks, IGL and MGL, which are the two CNG-focused city gas names, are our preferred picks in the gas sector right now.
Got it. I'll come back to you on telcos sort of in a moment. Let me get in Rashi in the conversation. Rashi,
Sure.
Just a word on what was arguably a sector which was in quite stark contrast to what Aditya covers, which is banking. What did you make of how the reportage was, and does the commentary or the subsequent price cool off in commodities lead you to think slightly differently about Q2 and beyond?
Okay. Thanks, Neeraj. So, just kind of starting off with cement, right? We've actually had a better than expected quarter. I'll start off with cement first. And what's happened there is that the pricing scenario has actually surprised us. I mean, cement price scenario has surprised us, number one. And in some cases, the companies have managed costs a lot better, than we had anticipated. Now, the thing is that when I say cost managed a lot better, it means, how the inventory is kind of being managed in terms of high cost versus low cost inventory, in addition to, self-help factors effectively. So here, now what's happening is the commentary, for the second quarter kind of becomes a little bit more uncertain, because what's happened is that until May, cement companies are very aggressively taking price increases. And then I think, the whole inflation impact that hit the entire country kind of got them to ease down, a little bit on the price increases. And since then, we've been seeing price softness. And come to think of it, if you look at cement prices today on an average versus the prior quarter, the correction is, or, prices are down anywhere in the range of about 5 to 10%, anywhere between 15 to 40 rupees a bag. Right. And so that's effectively going to have a little bit of pain in coming through in the second quarter. The commodity prices cooling off, which we were talking about is, diesel prices, or we're talking about petcoke, thermal coal prices. Again, I think it'll vary company to company. Those that have done a very good job in managing their costs in the prior quarter, may take a bit of a beating in this quarter because they'll still have some high took a beating in the prior quarter will, kind of be better off as far as costs are concerned. So this whole benefit of the commodity prices kind of cooling off, and and the assumption over here is that they remain cooled off, because petcoke prices have kind of come off. The Newcastle Richard Bay prices on the thermal coal side are still quite elevated. Indonesian coal prices have come off. So really depends on, how things progress going forward. But assume that the benefit stays, then we'll really start to see the cost benefit coming through in the third quarter on the cement side. Companies on the pricing side have been indicating that, now that inflation in India is generally coming under control, we can, kind of take some sort of price increases coming through. And that remains a bit of a wait and watch, because the window seems to be particularly narrow, given that this time the holiday season starts sometime in October. So we really have only September to kind of kick off, on the pricing side. So while the quarter has been good for cement, 1Q has been good for cement, I think 2Q can be kind of varied effectively.
Okay. Now, before we get to metals, and I'll come back on metals, but just a quick follow-up, Rashi, on cement. YTD rank underperformer, a bunch of stocks down 15-20% versus whatever the index may have done. And I read your note which said that you still remain selective because you believe multiples are set to contract. I think you upgraded Nuvoco, if I'm not wrong, and you have contrasting views on the two ex-Holcim current Adani Group stocks. Standard disclaimer, they own a part of the platform that viewers you're watching currently. Rashi, what's your sense here on selective names?
Yeah, so the whole idea of being selective is that we've come to a point where supply growth just continues. Even sort of before Adani came from the picture, our analysis suggested that cement supply is continuing on an ongoing basis. The rough numbers each time we look at suggest that almost 30 million tons of supply comes per annum on an average, right? And the absorption, and this is not stopping because the bulk of the supply is coming from the larger players who have strong balance sheets. So we know it's not, a tale of small players and it could be flaky. It's real in a sense. That's one. Second thing is that, while this mining bill kind of creates an entry barrier wherein you can, incrementally over the 10-year horizon, you can get limestones on an auction basis, but the entry barrier kind of only discourages the, smaller players again. Large, strong balance sheets will still be able to buy the limestone, will still be able to keep adding capacity. And most of them seem to be playing the market share game at this point in time. So that whole thesis that there is going to be a continuous supply, in the visible future, and you can, even before kind of Adani came into the picture, when you look at the individual companies, they've all got very aggressive targets, right? The numbers that they've all given out. But they talk about Dalmia, Shree, Ultratech, whichever one's the number they're talking about. And if I add if I add Adani into the picture, right, then that number only becomes more aggressive. Obviously, there will be an element of inorganic growth, I imagine, at some level. But if one grows inorganically, somebody else has to grow organically, vice versa. And Adani coming to the picture will only kind of propel the others to kind of accelerate their growth plans. So when we're talking about a consistent increase in growth, we're basically questioning whether utilization can actually accelerate, right? So on our assumptions, utilization is inching up and not accelerating, which takes us to the point that these elevated multiples that we saw post the Modi rally, are they going to stay forever? Or is there going to be a correction? In our view, there is going to be a correction. We don't see it correcting down to like the Indonesia, China levels because we are still very much a branded economy as far as cement is concerned. And India is still very much bagged, still very much housing driven. But I think some correction will come through. And that takes us to, not being like a blanket buy on cement and selectively choosing stocks. The selective choices come either, as a function of valuations, or as a function of, one, like pan-India story, you're kind of insulated from, regional variations, or, very strong self-help stories. So you spoke about the divergence between like the ACC and Ambuja, for example. Just looking at current valuations, right? Ambuja is probably close to about $160 an EV per ton, and ACC is in the $150 to $120 range. If they are both going to be managed by another company, which has the ability to basically bring about efficiencies and possibly adding supply, then that divergence may not necessarily be warranted. So there could be some narrowing of gaps, and hence the, the difference in our recommendations.
Got it. Thanks, Rashi, for that. I'll come back to your metals. Let me get in Aditya in this conversation and then go on to Surendra for a bunch of other spaces too. But Aditya, thanks so much for being patient. Let's talk about the space which arguably has performed the best and where the promise of profit performance seems to be the strongest. What's your sense on how did banking deliver?
Right. So performance and promise. So I think performance relates more to growth so far, and the promise relates a lot to margin in the coming quarters. So clearly, what surprised the most from where we were at the end of 4Q was the extent of growth pickup in the sector. So if we look at the banking sector growth today, year to date, and we look at year to date because that adjusts for any base effects, so then that's the strongest since FY11. At about 4% year to date. So, and it's not just limited to banks. We are seeing it in NBFCs as well. The one area of a slight disappointment in the quarter was on the OPEX front. So we had, while till the previous quarter, selectively some banks were seeing an increase in operating costs, but this time it became more pervasive. One positive, which was expected, was that asset quality was pristine across all lenders. The exception in this was maybe Mahindra Finance, which had to make additional provisions, but even they saw better than seasonal movement in stress. For the coming quarters, the key thing should be how does NIM perform? And for the last quarter, this was to a large extent a non-event. But this will be a key driver of relative performance in the coming quarters, in my view.
Okay, interesting. So there are some banks which are well placed on the NIM expansion side, some which are not so, but there the other factors might be at play. So where does this thesis of how the coming quarters are based squarely, largely, not squarely, on NIM expansion leave what could happen going ahead, Aditya, to the fortunes of individual banks, say ICICI, say some of the others?
Right, yeah. So one, at a sector level, this is the first cycle where we are seeing rate expansion after the repo linking of loans, which happened from 2019 onwards. So in the previous cycles, when floating rate loans were linked to MCLR or base rate, those benchmarks move to a large extent in line with cost of funds of banks, while the repo rate obviously is moving much faster. However, the loans reprice with a lag. Typically, there's a 1 quarter lag period over which loans reprice. So we should be seeing that in the coming quarters. So that's the fundamental positive which should play out for the sector. You have a material increase in the lending rates, at least on the floating rate loans. While on the deposit side, we are still to see a large increase in rate. Just as one data point, SBI's 1-year term deposit rate is nearly the same as the repo rate. So there is a fairly widespread. It's completely a timing game. It has to normalize in the coming quarters eventually. But over 2Q and 3Q, we should be seeing material NIM expansion. Now, the banks that you want to be in that are those which have a more retail-oriented deposit base, a high CASA. Within a high CASA, preferably a high current deposits, because saving deposits will shift to term deposits to a large extent. Also a high liquidity coverage ratio. So that gives them ability to replace bonds with loans. On the basis of these criteria, the one bank which is a top pick is ICICI, which checks off really well on a lot of these criteria. For mid-sized banks, the retail nature of deposits is slightly less as compared to large private banks. So there you might have more rate shopping and perhaps less. They might have to increase their deposit rate slightly more. For PSU banks, while the CASA is really high, it's driven to a large extent by current deposits, by saving deposits and not by current deposits. Okay. And therefore, our preference right now is for large private banks still. And within that, ICICI is a topic.
Okay, I will come back on the NBFCs and the non-lending financials in a moment, Aditya. But Surendra, get you in on the sectoral thing, and then one final round of questions about the spaces that we haven't spoken about with each of you. But Surendra, to you first. IT, what did you make? The last few days, I've read 3 or 4 of your peers come out and say that, hey, maybe we need to rethink this whole thesis of how much of a business disruption could happen in a recessionary scenario. What did you make of the numbers? What's your sense on the way ahead for large cap and mid cap IT?
Sure, Neeraj. So see, from a quarter perspective to start with, and then I'll go on to the outlook. I think a quarter perspective, I think the first thing, if you remember the narrative that was there 12 or 18 months back, it was firstly that growth is stronger for longer. And secondly, margins post-COVID will be better than margins pre-COVID. Okay, and a combination of these things essentially means that the multiples can remain meaningfully elevated compared to pre-COVID levels. Those were the 3 things which I used to come across in a lot of investor meetings. Now, where we are today, I think the second one, which is margins, are already well below pre-COVID levels for the large caps. In fact, some of the companies possibly reported margins which are very close to or at all-time low levels. The first narrative around growth stronger for longer, I think there are a lot of question marks on that, because we have always believed that IT growth is finally a function of corporate profitability. If global corporates are not making enough money, they can't invest enough. Nobody denies the need for IT, but there has to be an ability of clients to spend that money. And that is where the question marks are now coming. If you look at the recent earnings season in the US, there have been enough data points which suggest that corporates are really tightening their costs. And in that kind of a situation, even tech budgets get tightened. I don't think there is any doubt about that. So that's the first part of it. And obviously, if both of these things are more challenging than what people thought, then the multiple needs to be lower. And that is, so this quarter kind of established the point on margins, raised the question marks on growth, and automatically raised the question marks on sustainable multiples. So that is where we are. Now, kind of taking it forward from there, we would still be cautious, both large cap and mid cap, because see, if you look at this sector historically, the multiples are always connected to growth. While people look at the rupee very carefully, we have always been arguing that rupee helps only at the margin because the multiple is a function of revenue growth, at least among all other variables. So to that extent, as growth slows through the course of the year, we think that there is definitely a further risk to multiples. Pre-COVID, 5-year average valuation for the sector was 18 times. Even today, we are sitting at 24 times. When margins are already lower and growth, there are more questions. So when you put it all together, I would still be cautious on IT services. There has been a 25% underperformance calendar year to date, but the multiple is still pricey in context of the kind of earnings growth that the sector has to offer. So yeah, that's where we are on IT.
Okay, so then just one quick follow-up. There's a difference within the sector on multiples as well, right? Infy, TCS at a particular level versus HCL Tech, Wipro, or Tech Mahindra, and even at the mid-cap end of the spectrum. So where is it that there might be a limited downside, if you will, because the valuations are already materially lower than some of the peers?
Yeah. So I think it will have to be on a case-by-case basis, Neeraj. So for example, generally, when the cycle turns adverse on growth, the top companies do better. Okay, and these are names like obviously Infosys, TCS. So those are the top names, they end up doing better. And usually the mid caps have done relatively worse. Okay, so that's where we are now. Right now, where we are sitting, we are kind of taking a case-by-case approach, because on Infosys there is a lot of comfort on growth, and margins have already come down to levels where we don't think there is further compression, or at least meaningful further compression going to happen. So Infosys looks relatively strong, and they are positioned in the right growth areas as well. One of the things we are seeing in this cycle is, because this has been such a talked about recession for the last year, a slowdown for the last year, that corporates are still continuing to spend on priorities. There is no knee-jerk spending decision, which happened, say, around GFC, or which happened around COVID. That situation is not there in the market today. So people who are positioned in growth areas are still doing okay. So Infosys still looks relatively good to us within our cautious sector construct. And then again, among the next lot, we like Tech Mahindra primarily because we think that margins have room to improve from here. Right? Again, it's a bit of one-off factors. Last quarter margins also had certain one-time kind of costs, which will reverse going forward, and that should take care of the wage hike and so on. So on a relative basis, I think there is firstly going to be more margin resilience. Secondly, even from a growth perspective, a bulk of the revenue comes from telecom, BFSI, which should make it more resilient compared to some of the other companies which might be more exposed to, say, sectors like retail and so on. So that is where we are. We are fairly selective in terms of the stocks we are recommending.
Sure. I'll take 5 more minutes, people, but one final round. Sorry, just too many things to talk about, which is why it's going slightly over, but 5 more minutes with your kind permission. I'm taking that as a yes, even though you guys have not said so. Sort of, let me quickly come to you first. Telcos, what did you make of the numbers? We'll make it quick. And what's the outlook there?
Yeah, so the numbers, at least if you look at Bharti, they were slightly ahead of estimates on India Mobile, but most of the benefits of the tariff hike already had come through. I think the key is what happens going forward. So the big event was the 5G spectrum auction. Now that's behind us. There were uncertainties on how much the companies would be looking to spend in the auction. There was at one point a risk of a new entrant potentially disrupting the market. Now those events are kind of behind us. The commentary from management, at least of Bharti, has been fairly positive. While they are looking at an all India rollout over the next couple of years, and there could be some front loading of capex, their overall capex targets are still broadly in line over a 3-year basis. So no major negative surprises out there. Also, given the quantum of spectrum spend, I think expectations around the next round of tariff hikes will again start building up over the next maybe few months, where again Bharti remains pretty well placed. So Bharti does remain preferred pick. Valuations are still quite attractive at 7 times EV/EBITDA with a potential EBITDA CAGR of close to 15% over the next 3 years. Also, the third player continues to face challenges. There are delays in the capital raise. And along with a 5G rollout happening, one could potentially see market share gains for the stronger incumbents like Bharti and Jio.
Right. I've seen this. A lot of people don't even mention the third player's name. It's almost as if we don't want to talk about Vodafone at all. Let's just talk about Bharti and Reliance. But thanks for that, sort of. Rashi, may I come to you? I've time for one. So between ferrous and non-ferrous, I choose ferrous. Is the so-called super cycle, I'm not saying you coined the term, but is that so-called super cycle in ferrous over, or is it a speed breaker? Or was there never one?
I think you asked me a very tough question. But obviously there's been a fair bit of pain more recently as far as the China data is concerned, right? You can see the whole COVID hit, the power crisis in China that we're facing, and now the property data like got better last month, raised some hopes. TSF got better, and then again this in July again things started getting a little bit confusing again. So on the ground, it seems that things are not particularly great, at this point in time. But I think more from an equity perspective, where we're coming from it is we already know that, things are bad. And there's a general hope and expectation that the government will at least come to rescue. Obviously, the question is the timing of the rescue, the quantum of the rescue, that happens. But more specifically, what that means for India is that, we can't take away the fact that we are going to be linked to the regional markets, and import parity price. But I guess certain advantages that we have in India are the way the balance sheets have turned out, right? We probably had the best balance sheets for some of the companies in the last 15 years that we've actually seen. So when it comes about, sort of making choices, to kind of play this possible upturn, then India would be some of the Indian stocks, like for example, Tata Steel would be a good place to be in, with your debt EBITDA levels at like sub 1 time, and they're still talking about like a whole deleverage story effectively kind of coming through. And it appears to be reasonably valued in terms of, like at a 4 times EV/EBITDA on a consensus basis, which is, closer to 1 standard deviation below the mean. So to that extent, it's a hard one. I think the answer that, is there a super cycle? Are things going to change? There is fear of a recession. Hard to say, but I think that, the bad news is here at the moment. So one should start kind of playing for the good news that would, that is to come.
I'm glad I'm doing the questioning and not the answering, Rashi. What can I say? But thanks for that. Aditya, quick question. If you do track the non-lending financials, do you? In which case, I would love to understand from you. A lot of fairly eminent portfolio managers tell me that after a real strong lull over the last 12 to 24 odd months in the non-lending financials, maybe the time has come to perform. Maybe we'll see some of that in the print as well, the earnings print. That is, what's your sense, if at all?
Relatively more cautious, as compared to that statement. So both insurance and AMCs have a fairly strong market linkage. So for AMCs, about 70% of revenue comes from equity assets eventually. It's very closely linked to the market outcome. For insurance also, if we see the recent performance across products, individual protection has some execution bottlenecks and is slow. ULIP is vulnerable to the market outcome. A key part of the growth has been driven by non-par, guaranteed return, pension, credit product, and so on. Within these, I would be a little bit cautious on the non-par products as well, which has been the one strong growth engine, because these products are essentially a replacement for bank term deposits. And as we just discussed in the beginning, we are yet to really get into deposit competition among banks. And then when that happens, then demand for the non-par guaranteed return products should naturally weaken a little bit. So I'm a little bit more cautious. I think from a macro standpoint of rate cycle and growth picking up, banks and NBFCs have a much more direct leverage to that.
Got it. And we couldn't even discuss NBFCs, but Aditya, thanks for that view. Really, really appreciate it. Surendra, let's wrap up with one final question with you. The spaces that kind of did well selectively, consumption linked, autos, direct to consumer discretionary, maybe even some bit of FMCG because the commentary sounded optimistic about margins. Quick thoughts here before we wrap up.
Sure, Neeraj. So I think you are right. Selectively, even within the spaces you mentioned, the trends have not been that consistent. So certain companies have done well. So I think what is clear across the board is I think the optimism is more around cost inflation moderating. And that obviously will help earnings as we go forward. I think what we really need to watch out for is the strength in demand, because that is going to be key as we move towards the latter part of the year or towards the end of the year. So where we are, it does feel like there is a decent demand and then cost inflation should come down. And which is why like India trades at such a significant premium to EM. If you look at MSCI India, it trades at almost 85-90% premium to EM, which is a 15-year high. And that's the premium we are paying for that kind of visibility on growth and margins. So I think that really needs to come through for the market multiples to be supported at these elevated levels. But yeah, the outlook looks pretty decent. And as you rightly said, I think domestic sectors, I would say anything which is domestic in nature, tends to look better than some of the global or export-oriented stuff.
Great. Well, take a moment to thank all of you, Rashi and the gentlemen. Really appreciate you taking the time out and being with us for 37 minutes. Sorry for taking so much of your time, but just so much to discuss as always, but much appreciated.
Thanks, Neeraj.
Yeah. And viewers, thanks for tuning into this very special conversation with the think tank at Citi India.